So today we are going to continue with our receivables management. Lastly, we discussed initial aspects of the working capital management, and then we discussed payables management, inventory management, and we started receivables management. In receivables management, we have already discussed early settlement discount. I would like to give you a review of early settlement discount, and then we will move further. What is this early settlement discount? Early settlement discount means we are offering our customers to pay us early and they will be rewarded with the discount. Now remember one thing, in working capital management, there is no cash available. So we have no cash, either we are trying to take the benefit from the supplier for early settlement, or we want to purchase inventory at discounted price, or even if we want to offer discount to our customers. We don't have cash in working capital. Early settlement discount is basically a cost for the company. Company would have to bear this cost. Why? Because company wants to recover quickly or early from the receivables. So what alternative company has? Company has alternative of bank overdraft. Company will receive cash, or company will raise funds to finance this benefit of early settlement discount, which it is offering to receivables. Why? Because they are offering benefit to the customers to get early settlement, but they are not offered by their supplier to take the benefit of early settlement discount. So company would have to borrow from the bank overdraft, or alternatively, I would say that company is reducing its receivable and company will save its bank overdraft cost, because already company is using funds from the bank overdraft to finance its receivables. So bank overdraft interest is also a cost for the organization. Now company is comparing two costs. If company is offering early settlement to the receivables, it means now there will be reduction in receivables. Suppose previously receivables of the company were $1 million and now it has reduced to $70,000. So it means there is a reduction of like $130,000. When there is reduction of $130,000, it means now company will save its bank OD interest on this 130,000. But to save this cost, company would have to bear the cost of discount. So if discount offered, which is a cost for the company, is greater than saving on bank OD interest, then company will not offer discount, because saving is less than the cost, or vice versa. If discount offered is less than saving on bank OD interest, then company will offer discount to their customers, or company will offer discount to their customers for early settlement. So we are comparing two costs, one we are bearing right now and the other one which we are going to offer to our customers if they settle their liability early. So if they will settle their liability early and discount offered to them is greater than the saving on bank OD interest, then definitely we will not offer discount to the customers. Otherwise, we will offer if discount offered is what it is less than the saving on bank OD interest, then company will definitely accept the discount offer. Now, the second very important concept of receivables management is factoring. Factoring is also very important, and most of the time examiner asks this question if the question is asked from if question is asked from receivables management. Now, what is this factoring? Factoring basically is an arrangement where there is an organization who offers two types of services. One, it is offering specialized credit control services. What is meant by specialized credit control services? Basically, factor organization is offering you that they are capable to reduce your receivable days. They are capable to reduce your receivables. And the other one is they are also offering early cash, or I would say cash in advance. Or at times we say that they are ready to buy receivables. Not all the receivables, but 70%, 80%. So factor company is the one who has the specialty in credit control department, and as well as they have the capacity to pay a loan or cash in advance, or they will purchase receivables. Now factor company comes to you and factor company says that if you are unable to reduce your receivables or you are unable to recover from your receivables on time, we have the capacity to recover from the receivables on time. How? This is that please do tell us what is the amount of current receivables and what are the days of current receivables. So first of all, they will calculate your current receivables on the basis of current days. Suppose your current receivables are 5 million and currently your customers are taking 60 days. This is that we can reduce it to the acceptable level, and your acceptable level is suppose 40 days. So this is that we have the capacity to reduce your receivables. And if they are reducing your days, it means suppose this is that we are also reducing your receivables to the level of like 3.5 million, suppose. So they are reducing your receivables. What does it mean? It means revised receivables is 3.5 million. So the reduction is in receivables is what? Reduction in receivables 1.5 million. So they are reducing receivables by $1,500,000. Now there is reduction on receivables means what? It means there is saving of interest on bank OD, saving of interest on bank OD interest. Why? As I told you earlier and in the last class, that company don't have enough cash to finance working capital activities. In fact, company don't have cash. There is no cash in working capital. So, company is financing all its receivables and inventory either from the payables and from bank overdraft. So there is reduction of $1.5 million. This reduction is leading towards the saving of interest on bank OD. Suppose bank overdraft interest rate is like 8%. So what does it mean? It means there will be a saving of 120,000. On the other hand, factor company says that we are ready to provide you advance of this 80% or advance of revised receivables. But whenever they are providing you advance, they will definitely charge what? They will definitely charge interest on it. Do not think that they are going to offer you anything free of cost. They will charge interest on it. Suppose this is that factor interest on advance amount. This is that we will charge 1% more than this bank overdraft. So 1% plus means what? They will charge in fact 9%. But whenever you are calculating factor interest on advance amount, you will take revised receivables. Suppose they are ready to provide you 80% of this advance. So 80% of 3.5 million, which is 2.8 million, and do not multiply it with the 9%. Multiply it only with the incremental interest. Why incremental interest? Which is 1%, because if you will not take advance from the factor company, you will take advance or you will borrow loan from the bank overdraft and you have to pay 8%. So only additional cost due to factor is just 1%, not the whole 9%. You have to pay what? You have to pay 8% if you will not borrow from the factor company. So there will be an advance interest of 18%. Or I would say that interest on advance is 28,000 or additional 0.01%. Apart from this, factor company says that we will charge service cost on receivables management. So we have to pay factor fees, which is called factor fees. And factor fees is what? Suppose factor fees is like 1.5%. And factor fees is always payable on the sales revenue. Suppose our sales revenue is 30% and 1.5% means 0.015. So factor says that we are going to charge interest of 1.5% on total sales, which is again what? Again 28,000. So factor will charge what? Factor will charge $28,000 as factor fees. On the other hand, factor says that due to us, you will be able to save your credit control department cost. Saving of credit control department cost, like $5,000, suppose. So now there are two savings and two incomes. Currently, I am not incorporating saving of bad debts or cost of bad debts. I am assuming that currently there is no bad debts. So if we are going to hire factor company, there will be two savings, and some of these two savings will be 125,000, and there will be two costs, and some of these two costs is 56,000. So 125,000 minus 56,000, there is net saving of 69,000. So where there is net saving of $69,000, it means factor offer is acceptable or factor offer is profitable and we should accept the factor offer. So what does it mean? It means that if total benefit due to factor is greater than the total cost due to factor, we should accept the factor offer. But in case if factor offer is not providing us more benefit than the cost, then we will not accept the factor offer. So this is the factoring. And these are the steps which we are needed to deal with the question of factoring. It's once again, you can see it will start from the current receivable, then you will move to the revised receivable, then you will calculate reduction in receivables. After calculation of reduction in receivables, then you will come to the net benefit or loss. And net benefit or loss means what? First of all, you will calculate saving due to reduction in the receivables. Then you will calculate factor interest cost or incremental cost of factoring on the advance amount which a company will borrow from the factor company. Then you will calculate the factor fees which is payable on the sales revenue, and then you will calculate saving of the credit control department if it is provided in the question. Anyone, any question? Now in factoring, there are two types. One is called recourse factoring and the other one is called non-recourse factoring. Now it deals with what? Basically, recourse and non-recourse factoring deals with bad debt. In one type, factor company is going to take the responsibility of the bad debts, and in the other type, factor company is not going to take the responsibility of the bad debts. Which one where factor company is responsible and which one where factor company is not responsible? Recourse factoring is the one where factor company is not responsible of bad debts. Factor company will not take the responsibility of the bad debts. You are responsible of your bad debts. If there will be any kind of bad debts, you have to take the responsibility. And non-recourse factoring is what? Factor company is responsible. Factor company says that if your 100% of the receivables, 100% means what? They are basically purchasing 80% of the receivables from you out of the revised receivables. Or if they are purchasing 70% or 85%, whatever receivables they are purchasing, now they are saying that we are responsible to recover this whole sum uh, from your customers. If we could not recover, then it will be our failure and it will be considered as our cost, not yours. If we could not recover, then we cannot treat it as uh, as your loss. It will be considered as our loss. But a recourse factoring is the one where factor company says that if we are paying you 80% of your revised receivables, which is 2.8 billion, So it means we will recover 2.8 million either from your customers or from you. Means out of 2.8 million, we could recover 2,650,000 from your customers and rest 150,000 is bad debts. So this bad debts is your responsibility and you will pay us this bad debt amount. So we will recover the whole 2.8 million from you. So this is the difference between recourse factoring and non-recourse factoring. Anyone, any question? Now there are different issues which are related with the factor companies, or we can call these as advantages or disadvantages. Whenever a company is moving towards the factor company, it is not an easy decision for an organization because when you are heading towards this arrangement where you are involving an external organization in your receivables matters, which is a very sensitive matter because your business based on your customers or your business is lying on your customers, or lying means Laying or relying on your customers. So you cannot afford any kind of bad relationship or any kind of bad reputation in front of your customers. So the first issue is what? First issue is specialized service. When you are going to offer or when you are going to hire factor company, it means there is specialized service. Specialized service means they have the specialty in reduction receivables. They have the specialty to provide finance. They have the specialty to reduce bad debts to the level of zero. So they have different types or different kinds of specialty. This is one thing, or this is the first thing. Second is they are providing you advance. So advance is basically helping you to resolve your liquidity issues and immediately funds will be available to settle liability towards the suppliers as well as you will be able to take the benefit of early settlement discount if it is offered by supplier or you will be able to purchase inventory in bulk if supplier is offering any kind of discount or if there is any seasonal variation and you need to hold too much inventory at the start of the season or you need cash to settle your long-term loan liability along with the interest rate or you need cash to purchase non-current asset or you need cash to settle the leasing liability. So they are resolving your liquidity issues immediately. Second one is they are not only providing specialized services towards the ledger management, not only they are going to provide you uh, cash in advance, they are resolving your issue of written off receivables or bad debts because most of the companies are facing this problem and they are unable to reduce their bad debts or receivables uh, to the level of ideally zero or to its minimum level. They are somewhere facing this 3%, 4%, 5%, or maybe 10% as bad debts and they are unable to resolve this issue. They usually face this problem and it reduces or it affects their profit margin. Now the factor company is the one who says that if we are going in this non-recourse factoring, we will help you to resolve this issue ideally to the level of, for you to the level of zero, because we are taking the responsibility. Or otherwise, not only we are going to take the responsibility, apart from it, we will try that your all receivables should pay you on time and 100%. So these are the benefits of the factor company. But whenever you are going to make an arrangement with the factor company, so it means now you are going to share your confidential information. when you are going to share your confidential information about your customers, about your receivables, and the overall credit control department, credit control policies, your liquidity position. Now it is very much difficult for you to restore the existing position again, because now you are in arrangement where you have shared the information, where you have received cash, and now it will be difficult for you to arrange significant cash immediately to settle the liability of the factor company and to come out of this arrangement. So once you are in this arrangement, you have to continue with the factor company for a longer period of time. Apart from this, it can hurt or it can affect your relationship with your customers, because factor company has no interest in your customers. They have no interest in your business. They have no interest in your reputation or in your brand image. They only have the interest in their advance amount which they provided you, and they want to recover from your credit customers. If your credit customers will create any delays or any problem for the factor company, they will use different alternatives to recover their cash, which can ultimately lead to different kind of problem, and it can affect your relationship with the customer. Maybe your customers will settle the liability, 100% liability with the factor company, because now your receivables are managed by them, but they will not continue to have business relationship with you. So there could be loss of customers, and it is possible that you will lose the customers. So when you are losing the customers, what does it mean? It means that you have to uh, search new customers to maintain your sales revenue. But you are losing reputation because of this factor company, and the new companies, new customers will be hesitant to make relationship with you because they know that if there will be any delays in payment, then the factor company will deal with them, or they have to interact with the factor company. And one very important disadvantage is now this relationship will continue for a longer period of time. So it will continue for a longer period of time. These are the issues which are relevant with the factor company or factoring. So a very important aspect of receivables management is possible with the factoring, where company can resolve its liquidity issues, but it has its own issues. Now, apart from first one, early settlement discount, the second one is factoring. Third very important element is, or important type is called invoice discounting. What is this invoice discounting? Basically, apparently, it shows that we are going to uh, offer any kind of discount benefit to our customers to recover cash from the customers, but it is not the case. It is not uh, the early settlement discount. It is basically a cash uh, services service. Like I would say that it is basically kind of a loan, but not like the factor company. Here, invoice discounting is provided by bank or any financial services company. They are basically providing you what? They are providing you loan or cash. Against what? Against your receivables. Usually it is used in foreign transactions where we have foreign customers, and it looks us difficult to recover from the foreign customers, or we there is always doubt that if foreign customer will not pay us, then what will we do? We are going to make an arrangement with the bank, with our bank, and our bank is taking assurance from the our customers bank and saying that your customer will settle your liability on time. If not, we are going to provide you cash, and now it is at times it is their responsibility because the other bank is involved, or this is that you have the cash or liquidity to deal with your day-to-day manage problems or issues. When you will receive from your receivables, you can settle this liability. They will charge what? They will charge interest on this loan or cash. But they are not going to take any responsibility to deal with your receivables, and as well as not to deal with receivables, first thing, and as well as they are not going to take any responsibility towards bad debts. It is simply a loan. Like bank overdraft, but it is definitely different than the bank overdraft. It can resolve liquidity issue of the company, but apart from this, it has no uh, role in the receivables management. Company needs to provide what? Company needs to provide proof of money owed. They need to give a proof that they are expected to receive this amount in 2 months' time, 3 months' time. Basically, invoice discounting is not for everyone. To take the benefit of invoice discounting, you are running a company which has very high or good credit rating in front of credit rating agencies and banks. And most of the time, your customer, credit customer, is also having high credit rating in front of bank or in front of finance provider. Bank knows that if there is an arrangement that this customer will settle the liability within 3 months' time, its credit rating says that it will be settled within 3 months or before 90 days, but not more than 90 days. So bank knows that this company will be able to recover from the credit customers on time, and they will be able to settle our liability on time. So that's why they are ready to provide you early settlement, or they are ready to provide you loan basically. So this is called what? This is called invoice discounting. Now receivables management also faces another very important issue, which is foreign customers. When you are dealing with the foreign customers, there are number of issues which you have to face. First one is foreign forex issue, forex movement, which can affect you adversely. So how to deal with this? You can purchase any kind of derivatives, and you can go for hedging of foreign exchange. You can use what? You can use forward contract, you can use future contract, you can use currency options, or you can use currency swaps, or you can use netting or matching of receipts and payments, or leading or lagging. So there are different types of hedging techniques or derivatives which you can use to cover the risk of foreign exchange movement which can affect your business adversely. Apart from this forex movement, second very important element of the factor is that is called recovery. How to recover these funds from the foreign customers? There are different options. First one is bills of exchange. As I told you that you are going to involve two banks in this transaction. First one is your bank and the other one is your customer's bank. Your customer's bank is providing assurance to your bank that your customer will settle the liability on time. If your customer will not be able to settle the liability on time, then your customer's bank will settle this liability. So your customer's bank is going to take the responsibility of this receivable amount or payable amount on the customer's behalf. The other one is what? Other one is you can use foreign factoring. Factoring service is also available, not only like local factoring, it is also available globally. So you can use foreign factoring. Apart from this, you can use what? You can use invoice discounting, where you are certain that you will be able to recover from your customer within due time and your customer's credit rating is high enough along with your credit rating so your bank is ready to provide you loan. And you can do what? You can go for the export insurance, that they are providing you any kind of insurance that in case your customers will not be able to pay on time, insurance company is going to take the responsibility of this amount and they will recover your loss or they will settle your loss. So this is another important factor which is relevant with the foreign customers. Another aspect which is, or we can say that relatable with the receivables management, or we can say which is relevant with the foreign customers, it is called cancellation of orders. It is also possible that your foreign customer is going to cancel the order before delivery date. So in this case, financial institution either at your side or your customer side will take the responsibility and they will purchase goods from you and then they will sell in the market and whatever they will do, they will auction those goods, but they are going to hedge your risk or they are going to provide you assurance that they will settle your liability and your receivables. You will not face any kind of losses or any kind of disadvantages if your foreign customer will not be able to settle this liability. So this whole was what? This whole was receivables management. Right, everyone? Any question before moving further? Okay. Fourth aspect of the working capital management is cash management. Cash management means what? You must have optimal cash balance, just like the optimal quantity. Now, what is this optimal cash value? Optimal cash value or optimal cash, I would rather than a value, I would say that optimal cash amount. What is the optimal cash amount? Optimal means profit maximizing. So you must hold profit maximizing cash amount. How much? Profit maximizing cash amount could be like an amount which will not give you any kind of financial crisis or you will not face any kind of financial crisis. This is called what? This is called optimal cash amount. Means you will be able to settle your day-to-day liabilities. You will be able to settle your utilities on time. You will be able to settle your liabilities. You will be able to settle salaries of the employees timely. So there will be no delays in the any cash payment like interest payment, lease payment, or interest installment. So if you have enough cash which can be used to settle these liabilities, this is called what? This is called optimal cash amount. So optimal cash amount is the one which must be held by the company to settle its short-term liabilities or day-to-day liabilities. Company must keep cash for three reasons. First one is transaction motive or transaction reason. Transaction motive, I told you that transaction motive is to pay salaries, is to pay liabilities, is to pay loan liability, is to pay utilities. This is called what? This is called transaction motive. Apart from this transaction motive, there is a motive which is called precautionary motive. We must hold some cash with the intention that if there will be any kind of delays in recovery and we will not be able to settle the liability on time, then we have certain cash or sufficient cash in our accounts which can be used to settle the liabilities. So precautionary motive, we are holding a certain amount of cash. Third one is called speculative motive. Speculative motive is the one where we are holding cash with the intention that we will be able to avail the benefit of profit if there will be any investment opportunity in the short period of time, which can give us significant gain immediately. Suppose we have the opportunity to invest in securities, which can be profitable for us in the shorter period of time or in short period of time, either due to capital gain or due to interest income. So these are what? These are the speculative motives. So these are the motives. That's why we must always hold cash. But how much? Optimal cash amount. Now there are two different models which deals with the cash. First one is called Bumal model. Bumal model is basically just like POQ model. It says that a company should hold sufficient cash. When we are calculating economic order quantity, we says that company should hold sufficient inventory. Now, sufficient inventory means what? Sufficient inventory means profit maximizing inventory. Similarly, here we should have what? Profit maximizing cash balance. Human model says that we should have or we should keep sufficient cash which can help us to keep our two costs at the lowest possible level. Now, which are one are the two costs which we want to keep at the lowest possible level? One is called transaction cost. It is a replacement of ordering cost per order. Here we have annual demand of cost, cash. In EOQ, here we have annual demand of inventory. It is divided by holding cost of cash. And this Q is replacing EOQ. And here Q means optimal cash amount. This 2 is constant in EOQ formula and here as well. Transaction cost means the amount which will arise at every transaction. So company would have to bear this cost whenever the transaction will occur. Annual demand of cash, how much cash we need annually to settle the liabilities and as well as how much cash we need to uh, settle the day-to-day expenses or whatever. Now, important thing is what is this holding cost? Holding cost of cash means when you are holding cash or you are not investing in inventory, it means it is an opportunity cost for you. Opportunity cost means opportunity cost is the one which I can earn if I am holding cash of $300,000, and if I invest this amount in the bank, I can earn 6% per year, but I am not investing in bank because I want to hold cash either with the intention of speculation, either intention is precaution, either intention is transaction. But whenever I am holding cash and I am not investing, this is called what? Opportunity cost of cash, or this is called holding cost of cash. Opportunity cost of cash or holding cost of cash is the one which is basically a loss for the organization whenever they are keeping cash in their accounts. So this is very important to understand that opportunity cost means what? Opportunity cost is the interest which is offered by the bank. Now, in real life, in the business scenario, you can say that why are we taking interest as an opportunity cost? If a company is doing business, then their opportunity cost is loss of profit. It is difficult for us to determine what is the average profit of each and every business. Maybe grocery store has its own profit percentage, clothing company has its own profit percentage, shoe manufacturer has its own profit percentage, food seller has its own profit percentage, bank has its different percentage, hotel has its different percentage. So it is difficult to have average profit percentage from all the businesses. So that's why rather than considering profit percentage of business, we are going to make a benchmark which is the interest on deposit. So our benchmark is what? Our benchmark is interest on deposit, or we can call it government securities, which is the minimum opportunity cost, or I would say that risk-free opportunity cost. Everyone will be interested to invest surplus cash in this risk-free area to maximize cash or to maximize his or her wealth, or alternatively, we can say to compensate inflation. So this is called what? This is called benchmarking or benchmark interest on deposit. So opportunity cost of cash means what? Opportunity cost of cash means what? The cash which is not invested in the business is called what? Is called uh, cash held for transaction purpose or precautionary purpose or speculation purpose, and we are bearing the cost of it. Similarly, if we talk about EOQ, or if we talk about I would say inventory. What is meant by holding cost of inventory? Holding cost of inventory is not the storage cost of inventory or not the storage rent only. In case of inventory, there is also an opportunity cost, which is also part of opportunity cost or also part of holding cost of inventory. There is always opportunity cost of holding inventory as well. Because if you are purchasing inventory, it means now you are losing the opportunity to invest in bank, and you are losing the opportunity to earn risk-free income. When you are holding inventory, it means you think that you will be able to earn more profit in comparison with risk-free area, or more profit in comparison with interest on deposit or interest on government securities. So whenever you are going to use your cash either to purchase inventory and holding inventory, or you are not investing your cash in the business and you are holding cash to fulfill your day-to-day needs or working capital needs or operational needs. In either case, you are losing the opportunity of earning risk-free rate of return. This is called what? This is called holding cost of cash. And transaction cost will arise whenever you will perform the transaction. If you will perform greater amount of transactions, definitely your transaction cost will be high because every time you have to pay either the bank charges, either any kind of taxes or excise duties. So this is called what? This is called transaction cost and annual demand of cost. This is Bumal model. Bumal model and EOQ both are relevant with each other or both are close to each other. And what is their objective? Their objective is to find out optimal level, either optimal level of inventory or optimal level of cash. Now, what is the second model we have? Second model we have is basically known as Miller-Orr model. Miller-Orr model says what? Second is Miller-Orr model. Miller-Orr model is again relevant with what? It is again relevant with the cash management, but it says that whenever a company is going to deal with the cash or cash management, company should set three levels of the cash management. Just like, again, I would say that it is just like inventory. In the inventory, we have maximum reorder level, minimum reorder level, and average reorder level. Miller-Orr model also says that there is maximum cash level, there is return point, and third one is minimum cash level. Miller-Orr model says that whenever you are recovering cash from the customers, you will be able to do what? You will be able to hold huge amount of cash in your account because you are recovering from the customers. But whenever you are recovering from the customers, you will reach to the maximum level. And when you have reached to the maximum cash level, it means now your opportunity cost is too high, or now your opportunity cost is quite high. You are holding too much cash, but you are sacrificing investment opportunities. So holding too much cash is never suggested or not a good idea. So you should do what? You should start investing cash. You should invest cash in the inventory. You should invest cash in the short-term securities. Means you should invest cash in the profitable opportunities and go to the return point. Definitely, when you are investing cash in receivables, in inventory, in short-term investment, you will not only reach to the return point, ultimately you will reach to the minimum level of cash. And Miller-Orr model says that when your cash has reached to at its minimum possible level, now you should recover from the market or recover from the receivables, sell your short-term securities, try to sell your inventory, and once again reach back to the return point of cash, which is optimal point. But when companies start recovering cash from the market, they will not only reach to the return point, they will basically reach to the maximum level of cash again. So this cycle will continue and company will be able to find an optimal point, or company will always have at times maximum cash level or at times minimum cash level, and their objective is always to maintain what their objective is always to maintain return point. This is called forward, this is called Miller-Orr model. Now, Miller-Orr model says that there are a few things which we need to consider. First one is what? First one is lower cash limits. First of all, we should know that what is our lower cash limit. How much cash we can have or how much cash we should hold to fulfill our day-to-day liabilities, to fulfill our short-term liabilities. Second one, it says that you need to determine standard deviation of daily cash. Standard deviation is basically called variance or variation, that what variance or variation a company can afford in their daily cash flows. Standard deviation in the daily cash flows or standard deviation in day-to-day cash issues, this will basically lead us to what? Will basically lead us to maintain a balance where there will be no cash out and as well as where there will be no significant cash. Apart from this, then we are expected to determine what? Then we are expected to determine interest rate. And we will calculate what? We will calculate the interest rate. And then we need to do what? We need to estimate trading cost of buying and selling marketable securities. We have to bear transaction cost, trading cost of buying and selling securities. As I told you that when cash has reached at its lowest level, company should start sell its short-term investments or short-term securities. So whenever you will sell your short-term securities, you have to bear cost of on it, transaction cost or broker commission, whatever you call it, management fees. And similarly, when you have the maximum cash level and you are starting purchasing short-term securities or short-term investment, once again you have to pay brokerage fees or transaction cost, and now it is your responsibility to recover that brokerage fee and transaction cost and as well as add some gain when you are selling those securities. So these are the four important points which we need to consider when we are going to develop an optimal cash point in Miller-Orr model. Miller-Orr model says that basically you need to do what? You need to calculate spread. You should calculate spread. Spread is usually what? Spread is usually the difference between two values. Spread is basically, I would say that the difference between upper limit and the return point. Spread formula is usually provided in the formula sheet. It is also provided in your study text. 3 into 3 by 4 into transaction cost into cash flow variance divided by interest rate raised to power 1 by 3. This is the spread where we are calculating what? We are calculating difference between upper limit and the return point. And then we will calculate what? After having spread, we can calculate lower limit, which is necessary to maintain by a business, where lower limit, sorry, return point. Return point, which is called optimal point. So return point is equal to what? Lower limit plus 1 by 3 of spread. So you have already calculated spread, then you will be able to calculate the return point. So apart from the lower limit, you have need 1/3 of the spread. And this is the way to calculate the spread, which is dealing with what? It is dealing with the difference between upper limit and the return point. Return point is optimal point and lower limit is called safety or precautionary, just like the minimum level of inventory or safety inventory or buffer inventory. So you can call it safety cash or buffer cash, which is maintained by a business with the intention to avoid any kind of failures. What are the benefits of this Miller-Orr model? If we are following Miller-Orr model, it allows what? It allows basically to understand the random fashion of cash. What is this random fashion of cash? Random fashion of cash means it tells us or it helps us to identify when we will have huge amount of cash and when we will have lower amount of cash. Number two, it is giving us an opportunity to transfer cash. And we know that what would be the transfer cost whenever we are going to transfer the cash. It is giving us a space or a limit, or it is allowing us that within this limit you can transfer cash from one level to another, means from maximum to return or from minimum to return. So whenever you will transfer, what would be your transfer cost, or buying or selling of securities basically also falls under this transfer of cash. Then you can use control limits as a balanced management. Balance management is called what? Optimal cash flow. Optimal cash flow is called what? Profit maximizing cash flow. Now, neither you will face any kind of cash outs that you are unable to settle your supplier's liability, or you are unable to take the benefit of early settlement discount, or you are unable to settle the loan amount, or you are unable to settle the interest amount. And similarly, neither you are holding too much cash, which is not giving you an opportunity to invest and earn more profit. So you are not going to lose your opportunity, and as well as you are not going to bear any kind of negative consequences. But there are a few limitations as well. What is the few limitation? First limitation is it is not possible to calculate balanced cash every time. You cannot easily calculate balance is every point of time. Why? Because you have to face some problems. And it is not possible to have significant monitoring on the cash balance, which will keep the cash at the return point or optimal point. There will be definitely variations. At times, there could be more than the expectations. At times, there could be less than the expectation. So there will be these variations, and you have to uh, manage with these variations. So these are the limitations of the Miller-Orr model. Right, everyone? Any question? So if you have no question, then we have break for 5 minutes. After that, we will continue. Okay, now we are continuing with the working capital strategies and working capital financing policies.